What do my financial planning services include? What can you expect to get from it and the money you pay? Essentially, we're going to try to accomplish two things. We're going to try to accomplish, first and foremost, are you going to run out of money if you retire at a certain point? I was working with some folks yesterday. Husband wants to retire because he's traveling an hour and a half each way into his city. A wife got about 2 or 3 more years before she gets some pretty significant bonus money from RSUs, restricted stock units that come due. And we're just weighing all this stuff, and we're running numbers to make sure that A, if he were to retire at the end of 2019, he'll be good to go. B, what if she stays on for a couple extra years to get the extra money? Does she have to stay on longer than that, whatnot? And so that's what we're trying to accomplish there. So for them, we're just saying, okay, let's make sure you guys do not run out of money first and foremost. If we retire here, what if we retire there? What if we retire there? All these different things. On top of that, what if we spend this? What if we spend that? What if we spend X, Y, plus Z? So we're running all these different scenarios just to make sure they are good to go when it comes to retirement, for sure. We got to look at expenses, absolutely. In this case, because they live in the state, Georgia, that's very tax-friendly for retirees, this planning software, a lot of times, it doesn't necessarily reflect your specific state income tax. So we got to adjust that accordingly to make sure that we're not overtaxing you as well. And so a lot going on here, because a lot of financial software, if it's junk in, it's going to be junk out. And so there are some aspects of some financial software, to include what I use, which the state overemphasizes taxation, the state taxation. And we got to back that up a little bit. And we do that a bunch of different ways, for sure. Then we got to look at spousal benefits, the whole thing when it comes to Social Security. So the rule number one is, let's make sure you can retire and not run out of money. Absolutely. Now, to do that, I err always on caution. I always got to tell folks this. So for instance, I'm not saying what your portfolio allocation should be, but let me just give an example. If you had a 60-40 portfolio, 60% stocks, 40% bonds, we're going to give you a rate of return of about 4.7%. And that's not just for the next 10 years. That's for the entirety of your life, all right? That is a gross rate of return, not even including inflation and taxes. And how we get that is I just look at the Vanguard model, John Bogle, RIP, Jeremy Siegel over at Wharton, University of Pennsylvania, Robert Schiller at Yale. I mean, the idea is when you look at bonds, we know for pretty doggone close to a fact what interest you're going to get, what kind of return you'll get on bonds. Stocks, not so much, but given ideas of 5 to 6% year over year growth in earnings plus a 2 to 2.5% dividend, we could get a pretty good gauge. The stocks will probably give about 7 to 8% between the next 10 years, and I just extrapolate that going forward to err on the side of caution. So in that case, the stocks are giving you 7.5, the bonds are giving you 3. I think it's 3.25, something like that. 60% of the 7.5 goes of the 7.5% goes to 60% of the portfolio. 40% goes to 3 or 3.5%, whatever it is, and we combine those two, and essentially we're getting like roughly a little bit less than 5%. Very simple, very cautious. But I think it could be true. If it's not true and we get more, it's just icing on the cake. So if you can retire with that kind of structure, you're probably pretty good. On top of that, we inflate Social Security. We're only using the trustees report from Social Security at 2.6%. So your Social Security increase will go at 2.6% a year, according to the trustees report of the Social Security Administration. We're inflating general cost of living by 3. All right, so the price of your bread is going to be 3% more tomorrow or next year than it is this year. The price of your milk, the price of stamps, the price of gas, the whole thing. So your living expenses, discretionary living expenses, increase by 3%. Your property tax and your homeowner's bill increases by whatever you decide we should use for your appreciation on your home. Healthcare is a big one. So we're inflating healthcare by 5%, which is what the CMS, the Center for Medicare and Medicaid Services, says 5% a year increase on health costs. So we're increasing healthcare costs by 5%. So essentially, you got 2% for what's coming in, and you got 3% increase each year for what's going out, and healthcare is 5%. So again, erring on caution on investment returns, we're certainly erring on caution on cash flow as well. All right, so that's number one. Once we have that established, and again, it's just trial and error. We bracket, see what we can be doing. Can we retire then? Can we retire here? What if our spending goes down? the whole thing. What if our spending goes up? What if we want a vacation? You name it. It's what we're trying to do here. A lot of times we won't use inheritance. A lot of people say, I'm getting inheritance from my mom. My preference is to see if we can make this work without putting that inheritance in. But if we need to, we can. I don't like putting an inheritance in if it hasn't happened yet. I just don't like doing that. So I'd say 95% of the time we won't put inheritance in unless the client is decided in favor of that. So number 2 is taxes. Let's reduce the taxes. And I'm telling you, this is where it gets fun. So we just start looking at, okay, deferring Social Security until you're 70, taking your qualified accounts out at 62, for instance, whatever it is. We're going to make sure that we're doing it in the most tax advantageous way. We're going to start looking at Roth conversions. What if you convert 100,000 a year from 62 to 70? Just what if? We're going to look at gifting strategies. We're just going to look at taxes. And the nice thing is we use this chart. It'll show you, like, here's your taxes. It starts down here. If you do no Roth conversions, it goes like that. And then what we'll say is, well, if we keep that up, you're going to end up paying $832,000 of taxes, and your total net worth will be, $1.6 million. I'm literally just making that number up on the fly. But if we do Roth conversions, you're only going to pay $500,000 in taxes, and your total net worth will be $1.7 million. Which, okay, that's $300,000 less in taxes, $1 million more in net worth. That's pretty good. But then you also got to look at if you got heirs. Your heirs are going to get more of that $1.7 million instead of the $1.6 because they don't receive an IRA for taxation. And an IRA, 401k, 403b, TSP, an annuity all has what's called IRD, income with respect to decedent. So if we can avoid all that by having you take advantage of a married filing jointly tax situation while you're in the lowest tax bracket ever because you're no longer working, that way your kids won't inherit money when they're in their highest tax bracket. And now with a new secure bill that's probably going to pass and Trump will probably sign, they're going to have 5 to 10 years in which to exhaust any inherited assets that they get. So we don't want that to happen because that'd be a huge tax burden to them because they're probably in their most income producing time. When you're dead, they're probably 55 and that's when they're making their most money. So we don't want that to happen. So we got to be careful of that Secure Act. And then we're just going to say, okay, let's just make sure that when your kids inherit this, if you have children, you might not, then we'll look at other opportunities. QCDs, qualified charitable distributions, where you can take money out once you hit your RMD at 7.5. Instead of taking it out and giving it to you so you get a 1099, you just send it directly to your charity. It's a wonderful strategy. Tons of strategies to do in retirement for sure. But we got to take advantage of them. And we got to look at the big picture to make sure that A, you're not going to run out of money. And B, if you're not going to run out of money, we can do these strategies as well. We're going to look at estate planning like crazy. We got to make sure you have your wills, beneficiaries set up. You got to make sure you have a durable power of attorney, a healthcare directive, a letter of instruction. We're going to reinforce that with you to make sure that gets done. Now, I don't do that stuff, but I can certainly direct you to some folks that can, if not else, would certainly have you look at on your own. If you live in Seattle, Washington, I don't know anyone out there, so we'd have to put you in some contact with folks who can do that for you. You'd probably have to do that on your own, but I can at least give you some guidance in that regard. So we got to look at, again, beneficial. Oh, if you have a trust, we got to look at, do you need a trust? What the point the trust is serving? Is a trust funded? We got to look at that. We're going to hit Social Security hard, my friends, big time. We're going to look at Social Security incredibly hard. And we're going to look at your investments too. I mean, my goodness, we've had tons of people who've got, they got unrealized losses in their account. And I'm like, why are we selling this to take the loss and lock it in? And then we have other people who say, I'm just going to go ahead and give cash to my charity while they got major unrealized gains. We don't want to do any of that. We want to give the gains to the charity and sell the losses. I mean, there's a lot going on there, which will be tough to elaborate here in this short video, but we've got to look at the big picture of not just your 1040, but your actual investments, the way they're set up right now as well, because there is tax consequence, even if you're not retired, significant tax consequence. So we'll look at that as well. So at the end of the day, what the hope is that, frankly, that you never need me again. My hope is that we get you on a good enough path that A, you can retire, B, have a plan of action for planning on retirement, C, have a plan of action to reduce taxes in the future. That's the goal. That's what we're trying to accomplish. We're going to make sure your estate, we're going to look at your life insurance if you have some. If you have a cash value life insurance, we're going to get an in-force illustration to make sure that puppy is still good to go, that it doesn't expire before you do, because that's the wrong answer. So we're going to talk about just a ton of different things, all under the context, can you retire? Yes, and how do we reduce the taxation and maximize your net worth once we can establish you can retire. That's what we're trying to accomplish. And so again, as I talked about before, if you have a liquid net worth under $500,000, and liquid net worth is everything you own, 401k, bank account, checking account, you name it. If it's liquid, i.e. it's an investable account of some sort, not real estate, that is included in the liquid net worth summary. If that's under $500,000, I charge you $950. If your liquid net worth is above $500,000, I charge you to $2,500. And then we're going to have a first meeting. So what happens is you pay, I get you access to software. You fill out the best you can. You don't kill yourself. Just do the best you can, man. And just literally no reason to sweat that. And then we'll set up a call to go over that to make sure all the I's are dotted and the T's are crossed. Okay, so we're going to say, okay, Joey and Jane, this is Josh. Let's go over this. Okay, I see you have Social Security. How did you get those numbers? I wasn't really sure. Okay, we're going to go over that pretty thoroughly because that's critically important. So after we take about an hour and a half of doing that, we hang up. I need a couple of days to kind of chump the numbers, to crunch the numbers and whatnot. Then we get back on the horn and I present you my findings. And I share my screen with you. All right, so I don't do this in person anymore. It's just way too time consumption to do this face-to-face anymore. So I share my screen, and then you'll see exactly what I'm looking at, and I share with you the method of my madness, and I give you the reasons why I think you should do this, why I think you should do that as well. From then, I'm feeding you with a fire hose. So at that point, after we hang up, there'll be another hour and a half or so. You might say, okay, that's good enough for right now. I have to look at this. And you might have questions later. You might not. I don't know. But if you do, just fire them away as an email. I'll be happy to answer them for sure. And essentially what I say to people is like, look, if you want to revisit this every couple of years, that's fine. I'll probably charge like $500 for an annual check-in, so to speak. I haven't decided that yet, but roughly it'll be an annual check-in fee for $500 or something like that, and we'll just go over where we left off. Like look at a 1040, look at your investment statement, anything jump out that we need to be looking at. And that's pretty much it. I mean, and then then you have unencumbered access to the software, the Right Capital software, which I absolutely love. In my opinion, it's the best software in the business. You'll have that as long as I continue to pay. And right now, I just love it, so I don't have any thoughts of changing over. But I reserve the right to do that without telling you, and then you just won't have access to the software anymore. I guess that's it, man. So really, nothing more than that. Is just trying to accomplish all this. Oh, I don't give refunds because you're paying for my time. You're not paying for the results, you're paying for my time, and my time is used regardless if you like the results or not. So just keep that in the back of your mind. So, look, I know it's a big expense. I get it. It's not for everybody, for sure. I don't manage money. I don't want to. I don't think it's a value added at all. And at the end of the day, my goal is, like I said, is, after a couple meetings and you're on your own to implement this, what we talked about, to move forward. If you want to check back with me every couple of years, more power to you. But you don't. My goal is that you don't have to, but you're certainly welcome to for sure. So anyway, hope this helps. If you have any questions, just let me know. Don't forget to email me at josh@heritagewealthplanning.com if you want to talk about your specific financial plan. We just got to set up the time to go over this. And frankly, this is going to sound arrogant. I just don't have the time to kind of go over my offering with everybody in advance. I just don't. So you'll have to, at some point, you're going to have to make a decision, is it worth it or not? And I get it. It's a lot of money, man. So I don't envy you for having to make that decision. But if I do have 1,500 videos that you can watch. So I have everything covered without you having to pay me for sure. It's just you have to figure it out on your own. Not a big deal, but I get it. I just don't have the time to kind of talk to prospective clients about what we're going to solve because I don't know. And frankly, I just don't have the time. So anyway, hope this helps, and we'll talk to you later. Thanks now.